Hey, this is Danielle, and I have been on maternity leave with my beautiful baby girl, but I'm trying to get back in the swing of things here. And today I decided to take a stab at the SPX when it was rolling over and dying right before the close. So here I come to you with my trade review video where I'm going to discuss how you can short the market using 0DTE SPX and the market internals for quick day trade at the end of the day. So this trade is actually going to settle for a little bit more than what it says right here. It's about $800, but it'll probably settle for about 1,000 because the in the money put ended up being in the money by about $13.31. And this was a $25 wide butterfly. So in this video, I'm going to discuss why I use out of the money butterflies that are very cheap in nature using 0DTE SPX. And then I do that with a goal of getting them in the money so that you can make a quick profit at the end of the day. Now, I will note that this works the absolute best on trending days. Those trending days are going to be, for example, Fed days. Those are generally a really good day to step in front of it. Anytime that there's big news, doesn't matter one direction or another. So today, for example, NVIDIA earnings came out and they weren't bad. They just weren't amazing, right? So market started selling off. Anyways, how do you do this? Why do you do this? Here's my live charts. It's kind of late at night. That's why these are all kind of zeroing out now by the time I'm making this video. But essentially what happened here today was if you look at the S&P, this is the S&P futures on a 5-minute chart. We had opened up overnight. This is the overnight trading session after NVIDIA earnings over here, and basically immediately started selling off. So big red candles. We also had high volume selling. And then throughout the course of the day, the market attempted to trade higher, but it could never get through the high on the day. When the market can't get through the high on the day, and especially can't even get through like a basic resistance zone, that's a pretty weak signal going into the end of the day. Now, as I noted, I'm still on maternity leave and I'm not, really trading all day. Generally, I've just been kind of coming in at the end of the day. So I will note that this was a bigger move than the move that I actually caught here at the end, but still shows you kind of the power of what you can kind of do at the end of the day. So here I am. I come in to the end of the day, I look at the market, say, wow, there's been this high volume selling all day, couldn't get through the highs, couldn't get through resistance, is it too late to short the lows is basically the question. Now, in this moment, I had noticed that the S&P was sitting right at 5,900. Anytime you have the S&P futures sitting on a critical support zone like that, key psychological value, all you need is just a little bit of selling and that thing can break and flush pretty hard. Today the flush, I mean, it really wasn't that hard, but it was still enough to trade it for 20 minutes, 20, 30 minutes. I think this was actually like 45 minutes, but you get my point. So when you're sitting on a ledge like that, what you have to watch for is you have to watch the market internals. Now, I like to use the ticks, the vol spread, the book call ratio, and the UVXY. Now, in this case, this was the main leader here. Basically, with the ticks, you are going to look for an overall lack of buying, and then you also want to look for major selling. So, a lack of buying is when the ticks cannot get above plus 600. That's, basically nobody's making an effort. There's some wicks here. Some buyers tried to come in, but it just did a womp womp move, and every time the buyers just rolled over and died. Now, you'll notice that it rolled over to the negative 1,000 level, and granted, it didn't stay down there, but it was down there earlier in the day, and it was staying down there. But it did stay down here at the negative 600, quite a bit, whereas it couldn't even get up to the plus 600. So this was definitely more selling than buying. So that was another reason to short it. Now, I think I got into the trade It was like right around here. I'm on the Pacific coast, so about 12:15, 12:20 or so, about 40 minutes before the market closed. And then basically when you short the lows like that, what you have to watch for is you're completely wrong when the ticks go up above plus 600 and stay there. That's when you just get out, you say, all right, this didn't work today. And so I stayed in the trade because that did not happen. Now, if you look at the vol spread, this is a measure of the volume up, volume down. Um, as you can see, it was just rolling over, rolling over, rolling over. That's more selling than buying. There was this little blip right here where I thought, oh, man, maybe I'm going to get stopped out. But then the last 10 minutes of the session, that's generally on these weak news related down days, that's when it's generally going to roll over and die. So just holding the plank, waiting for that moment. And then once I saw the vol spread just start to roll, I knew that that trade was most likely going to work out. We also had the put call ratio that was just continuing to climb throughout the session. That demonstrates that people are buying puts. Another thing that was really interesting about this, especially since I haven't really been trading since I've been on maternity leave, is that the put call ratio has been extremely low. Whenever the put call ratio is this low and then a flush comes in, that's when the market can really get hammered. So since it's been low overall, and since, it has been climbing over the course of the past really 2 sessions consistently. Yeah, it was up here for sure, but climbing consistently for 2 sessions. That kind of told me that there wasn't going to be a short covering rally because not enough people were short. So at the end of the day, you do have to watch for a potential short covering rally. I like to trade those a lot as well. But in this instance, I just was betting on there not being one because the put call ratio has been too low. There weren't enough shorts to cover. And then also the VIX just kept going higher. When the VIX keeps going higher, generally shorts aren't covering. So moral of the story is the reason why I traded 0DTE SPX is because in the options market, basically these options are going to expire that same day. So you can get into the trade and just let it cash settle. It doesn't count as a day trade. Now, I am a designated day trader, so that does not matter to me personally. But if you have less than $25,000 and you can only do 3-day trades a week, then it would matter to you. So, in this case, the reason why I like it as well is because the what's going to happen here is that the premium in these options is going to get crushed like really quickly because the way that options work is, they have a value and they go down in value until expiration. So when you get into a trade 40 minutes before it expires, the premium is just dropping out of it like a rock. So for a situation like an unbalanced butterfly or put credit spread, that can be really beneficial. Now, another reason why I like the 0DTEs is because you can use your options chain and you can look for options that are standing out. So, for example, in this case, I had bought the 5850s, well, sold the 5850s because there was a lot of high open interest here. So that can oftentimes be a target when there's quite a bit of high open interest. So, I used to use this setup for trading S&P futures, and I started doing the 0DTE SPX. I don't know when it started getting popular, and it is certainly different trading it in that way because you need to use your options knowledge. But what's really great about it, especially compared to futures, is that it's a lot less expensive. So in this case, I just did one contract. It was $4.15. So less than 500 bucks. End up getting out of it for about 1,000. It says right here 757, but it moved really quickly at the end of the day, and it'll cash settle for a little bit higher. But basically, with this trade, it's a situation where you have fantastic risk to reward. So the risk was 400 bucks. The max profit was 2,085. So in that situation, basically what would have happened is the if the SPX went all the way to the center strike of the butterfly, then I could have made $2,000. $2,000. You're never gonna get the exact. Um, so you basically just have a really good risk to reward. Now, in this case, what I was trying to do with this thing is I want to set up a butterfly so that it is slightly out of the money when I get into the trade. And the idea is that on one of these trending days, because this was when I got in, right? 58.81. I was trading at 58.81. And then the idea is, if the market can roll over and die, you want the market to fall through your long strike. So this is a long put right here. And then you want it to stay between this long put and these short puts, because then what will happen is this put that was pretty cheap because it was about to expire, right? Is now increasing in value because it goes in the money. Okay, so that one goes up in value, making money there. And then what also happens is, as long as this one stays out of the money, you sold two of these, by the way, then those are decaying because your premium is decaying because you have bought an option, or in this case, sold an option that's going to expire the same day. So that premium decay is going really quickly. So then you can make money on that strike as well. And so by buying this strike and selling the strike, and then you buy another one for protection in a standard butterfly, you're basically going to get yourself a pretty cheap trade. $4.15 is $415. It's not bad if you're trading futures, depending on whatever brokers you're using. I mean, it could be $500 margin, it could be $5,000 margin, like in TD Ameritrade. So I like trading butterflies. This is how I shorted the market today with 0DTE SPX. Like I said, I've been on maternity leave. I've been spending a lot of time with my kids and haven't really been trading all day or that frequently. But what I like to do is I like to come in and trade the close. So I've always been a trader that loves trading the close. The close is all about the feel of the market. It's all about the market internals. It's also the time where you can get these really quick movements. So it's not too bad to get in a trade, get out, and there you go. Onwards and upwards. So missed everybody. I'm looking forward to making some more videos. I also wanted to make this video because I saw a comment on the video that I posted earlier today, so I hope this is a helpful response. But to summarize all of this, what happened today, it was just a reaction to NVIDIA not being as excited as maybe many people were hoping for. But I think overall, we are probably on board. We're probably on board a ship with a lot of volatility in the near term, especially because we've now broken through the 50 simple, broken through the 100 simple. Ideally, we don't break the January 13th lows. That would not be a great scenario because then we'd probably be all the way down here at the 200 simple. But I don't think it's that surprising that we're seeing this near-term volatility. It's pretty typical for February and the beginning of March. After that, we do generally see more of a bullish move going into earnings in April. But we'll just have to take it one day at a time and see where this thing takes us. So let me know if you have any questions down below, and I'll see you in the next one.